Realty Income is a real estate investment trust that specializes in owning and leasing commercial properties through their long-term net lease agreements, and they're well known for their monthly dividend payouts as well as focusing on stable income generation. Now, in a year where the majority of the market has performed phenomenally well, we can see that the REIT sector has been struggling, with the majority of companies in fact down, and Realty Income is no different, down around 4% year to date. Now, we can see this company is trading towards its 52-week lows, with every single analyst now believing this company is a buy. As we mentioned, they pay out every single month and the current yield sits at 5.7%. Now, not only do we get every analyst telling us to buy this company, but when we do look at some of their important grades, valuation at a B, growth at an A+, and profitability at an A, does make us think that this could be one to consider for every investor's portfolio. So let's break down a few things and also get to our own valuation, with some news this week that the Federal Reserve are meeting, and it's very likely that we will see interest rate cuts for the third time, sitting somewhere around 25 basis point cut. Now, why is this a very good sign for a company like Realty Income? Well, typically for REITs, lower rates help reduce their borrowing costs, make it cheaper to finance property acquisitions, operations, whilst also increasing the attractiveness of their dividend yield relative to lower yielding bonds and saving accounts, drawing in more investor interest. Now, we want to highlight here their debt summary, because whilst we did say it is a bullish sign, we just want to highlight that for Realty Income, they do hold the vast majority of their debt, 97% in fact, at a fixed rate, and as we can see, on average it is just below 4%, and with the average weighted years until maturity coming in at over 6 years, it isn't going to be some time for this really to affect Realty Income, and with interest rates coming down, this isn't likely going to be one of those situations that does get investors sweating, at least for the shorter term. Now, when we take a look at their earnings over the next 4 quarters, they are expecting growth to the FFO, the funds from operation, something we do draw your attention to for REITs, which is a good sign. Although one thing we do have to say is that over the last 4 quarters, including the most recent one, they did miss, giving them only a 25% track record. And if you have some faith in their historical forecasting accuracy, well, over the next full accounts, the FFO of 4.4 is anticipated to lower the forward P to FFO to 12.56, which we will come to show you is currently trading at a discount to the overall sector median. Now, in terms of the quality of the company, the underlying metrics, first thing we want to note is the dividend safety score sits at 80 with a safe rating. Very important, especially given the fact that they pay out a dividend on a monthly basis. The company currently looks severely undervalued on both of these valuation models that we will shortly discuss, and over the last full year they have increased that dividend by around 3%, which we would say is roughly around the inflationary rate. In terms of when it was reaffirmed, well, just a few weeks ago, that ultimately a dividend cut for Realty Income is unlikely. Now, what about the key metrics? That is from the latest recession, the 07-09. They actually increased the dividend. We see negative 1% sales, which is above the average of the S&P, sitting at negative 12. And they also marginally outperformed in terms of total return, negative 43, the S&P itself, negative 55. Now, yes, we do love this company for those monthly dividends, but do bear in mind, in terms of the growth, it isn't nothing to write home about. In fact, over the last 20 years, they have increased it only marginally above inflation at 5% year on year. And we can note they are a dividend aristocrat with 25 plus years of consecutively increasing the dividend, with 55 years of paying one without a reduction. Now, the first valuation model we are looking at, when we do zoom into the last 12 months, and also bear in mind we're not looking at any of these in isolation, we will conclude when we get to our own process towards the end. The blue tunnel indicates the intrinsic price. What is the fair value? Right now we see it, and in fact for a large part of 2024, well below the bottom end of this fair price, indicating severe undervaluation. We then move on to dividend yield theory, which tells us a company is undervalued when the current yield sits above the 5-year, 5.72, well above 4.67, but also another undervaluation flag here, 12.9 on the AFFO ratio. That is well below the 5-year rolling of 16.8. And as we mentioned, this company does trade lower than the sector as a whole, which means it is trading at a discount. Now look, some companies do deserve to be trading at a discount. Some companies also deserve to be trading at a premium. Our question is to identify, does this deserve a discount, or in fact, has the market overreacted? Have they put these type of companies to one side whilst other sectors grow significantly, and should we be looking to take advantage? Now, typically on this channel, we do draw your attention to the free cash flow. However, for REITs, they are a little bit more volatile, so we focus on the adjusted FFO, funds from operation. Below 90% is what we want for REITs. Not only below that for Realty Income, but also decreasing 76 in 2023, anticipated to go a bit lower over the next 12 months to 74%, which tells us and supports what we noted above, that the dividend does look to be safe. Now, AFFO per share, similar to when we look at normal companies' free cash flow, we want consistent increases over the longer term. And again, this is something that Realty Income delivers in, 415 on a trailing 12-month, 429, so it is expected to go higher over the next 12. Then we move on to what is the sales growth, where for REITs we want to see 5 to 10%, and that is something we get for the large part for Realty Income. In fact, the last 3 years have been very strong, as well as 29% on a trailing 12-month. And very important with Realty Income as well as REITs, focus on the AFFO per share growth, as they will and will highlight below do dilute your position, so this becomes very important. Not too bad over the longer term, 4% on a trailing 12-month, around 3 anticipated over the next 12. And when we do look at the numericals for total sales, we can see just under 1 billion 10 years ago, over 4 times at 4.1 in 2023. Now, as we mentioned above, they do dilute your position over the longer term, and in fact are one of the REITs that do this at a very rapid rate, whilst the whole industry is something that is very apparent, being the reason here that they do retain a little of their internally generated cash flow after paying dividends. We still do believe it is important just to identify whether or not they can grow their adjusted funds at a much faster rate. And don't forget, the whole point of us looking at shares outstanding is to identify companies that effectively buy back a lot of shares, returning excess cash to investor pockets. ROIC typically on this channel, 10% or more, give us faith management are able to effectively allocate their capital. For REITs, we want to see 3 to 5%, something that they do pretty much deliver year on year. And then when we get to the operating margin, not bad over the long term in the 40% region, 44 on a trailing 12-month. But the main one that we do want to highlight today is the net debt to EBITDA, the earnings before the interest, tax, depreciation, amortization, below 5.5 for REITs, and the numbers below are reflective of the number of years it would take the company to pay off all of their debt net of cash on hand. Now remember, this correlates to dividend safety and balance sheet strength, 6.05 in 2023. In fact, the majority of the last 10 years have been trading above the maximum threshold we want to see. Nice to see over the next 12 months, it is anticipated to come down to 520. But remember, these things we do need to keep our eye on a quarter by quarter basis, especially for Realty Income. They do pay a monthly dividend, and whilst right now it looks to be safe, things can change very quickly in this market. Now, we want to let you know we have released our latest weekly article, the number one stock we are buying heavily in the month of December. Now, we release one every single Monday morning to your inbox for free. New one coming tomorrow. So click below, you can sign up, start reading straight away, where we highlight severely undervalued stocks for your attention, as well as what's gone in the market over the last few days. On top of that, you can grab a copy of 28 undervalued stocks for the month of December, as well as the upside that Wall Street themselves see over the next year, as well as a recently released copy of 29 stocks that Wall Street themselves believe have the most upside in the S&P 500 right now. So click below, you can sign up and start reading straight away. We then move on to insider ownership that sits around 0.1%, with around $900,000 worth of sales over the last year. Now, we do notice in the most recent quarter there is no data. Q3 we do see around 411,000 selling. Now, while we will be transparent, show you the insiders, one thing we do want to note that insider selling for us Not a bearish signal, they sell for many reasons, personal or financial, and we can see here the most recent sale, 11th of September, the director selling over 1,700 shares, netting them $100,000. Again, information is here if you do want to include it in your own investment thesis. Now, institutional ownership sits around 71%, around 1.6 billion worth of sales over the last year, but around 4 times as much buying during the same time frame. And we also notice in the most recent quarter, institutions have been buying a lot more. So institutions clearly very bullish, but we do want to highlight here that always do your own due diligence, never copy what insiders or what the institutions do. Now, we've already flagged their top line, as we mentioned, pretty much a 4 times growth over the last 10 years, but we also want to draw your attention to the bottom line net income. What story does it tell us? Is it something very similar to the top line revenue? And you could argue not massively, in fact very inconsistent, pretty stable from 2014 to 2021, then a massive jump and pretty stable. Now, these are things that you can factor in, for example, if you do take this as maybe a negative, as we will come to use a margin of safety towards the end as well. Then we'll move on to the balance sheet, a quick health check, total cash versus total debt. We can see their cash very inconsistent over the period, going from 4 million to 397 in the latest quarter, and we will compare that to their total debt numerically and directionally, because ultimately one number here will not give anything away. Total debt, no surprises, they are a REIT, this is very typical. It has increased over the period, in fact more than 5 times, from 5 billion in 2014 to 27 in the latest quarter. Now, as we saw, that net debt to EBITDA was a bit of a question mark and something we would advise just to continue to analyze quarter on quarter, year on year. Then we move on to the first grading, which is valuation, where they get a B. Now, we have a lot of metrics here that you can incorporate, but overall the main one we do want to focus on for REITs is the price to adjusted funds from operation on a forward basis. 13.2 for Realty Income, sector median at 16.4. So right now, if you're buying this company, you are getting about a 20% discount. Is it worth it? Again, something we do need to consider before buying this company, because as always, some companies actually deserve to be trading at a discount. Now, if you look at the growth, they got an A+, so maybe actually they don't deserve to be trading at a discount if they are growing very strongly. AFFO growth over the last 3 years, 5.7% year on year, better than the sector median. Over the last 5 years, 4.6%, better than the sector median at 2.15. And if we look over the next 12 months, 3.4, again better than the sector median. If you want to see the other metrics, although we have covered some of them, you can see as well, looking fairly favorable. So it does look like this company should be trading at a premium perhaps, as opposed to the discount it currently has, and the profitability at an A, another reason here why you could consider this fairly undervalued. Cash from operations, A+, 3.4 billion, with the sector median at 237 million. So quick recap for this part of the analysis: a triple buy from Seeking Alpha, Wall Street and Quant, B on valuation, A+ on growth, with an A on profitability. Now, 2 more things before we jump into our own valuation process. First one, how do they compare against others in the REIT industry? Simon Property Group, Kimco, Regency, many well known that people will have heard about for sure. Over the last 12 months, including dividends reinvested, they are the worst performing, and what we can see, actually the worst performing in pure isolation, as others in this space have actually done fairly well. When we zoom out to over the last 5 years, what we can in fact identify is, if you bought this company 5 years ago today, you started to reinvest those dividends every single month, you would pretty much have the exact same amount than 5 years ago. Pretty phenomenal stat to think about, not in a good way at all, but very interesting to note, whilst others would have given you some kind of gain. In terms of the last 10 years, we can see they're actually one of the best performing, which is very interesting, from going from the last year, the last 5 years, to the last 10 years being a complete flip, which is why it's always important in your own investment strategy to think about the longer term. Now, whether or not you believe this is a good rate to have over the period, past performance is not at all an indication of the future. Could perform a lot better, could perform a lot worse. Also, interestingly, how do they perform against the S&P? Well, massive underperformance over the last year, massive underperformance over the last 5 years, over the last 10 years, again, massive outperformance by the S&P. But we do understand a company like Realty Income, it does pay nearly a 6% yield on a monthly basis. Some investors will use this purely to pay for their expenses, but that is why we need to each come to our own individual investment thesis. And again, we highlight this just in case you don't have faith for this company over the long term. You could consider a low-cost ETF. Now let's jump into the valuation model where we do get an intrinsic value of $69. We're going to run through the three. It is essentially the average of these three, which we can quickly run through. The first one, the multiples valuation model, companies in a similar sector and size that we saw. The average P to AFFO, which is a lot higher than Realty Income, as we said, trading at a discount, which does give here a very fat undervaluation signal. Although do bear in mind, we're not looking at any one of these in isolation. Dividend discount model, average growth, as we already noted, just above 3%. We've gone there or thereabouts over the longer term, which as we can see, another undervaluation signal. And then we get to the DCF model, free cash flow year on year, average growth 20%. We've gone a lot lower at 8%. With the discount rate, we get the present value of future free cash flows and terminal value, add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, and as we can see, our third undervaluation signal, on average, coming to $69 with the current trading price at $55. Now remember, on this channel, we always start off with a 10% MOS, which we execute if it meets our 3 golden criteria: wide moat, strong financial metrics, and good forward-looking data. Now, if you believe that in today's episode, a buy at $62, then we keep going till it's near the current trading price. And what we can see, Realty Income, the monthly dividend-paying company, gives now a 20% MOS, with Wall Street anticipating $65 over the next year, upside of 18%, which could make it very attractive. You're getting a discount to a company that pays a yield of nearly 6% every single month with Wall Street if you do take their word at upside of 18%. But as we always say, take it with a pinch of salt. If the share price goes up, they'll revise it up. If it goes down, they'll follow suit. As always, give us your thoughts in the comments below. Is this one you are looking to buy? Maybe you're waiting for it at a lower price, or in fact you do hold it and you're just waiting to see. Don't forget to sign up to the free weekly newsletter. We are dropping a copy tomorrow morning. Grab those spreadsheets and come and join us in the Patreon where we cover our weekly buys and sells. As always, have a great day and we'll see you all on the next one.